Good afternoon, everyone. Thanks for joining us today for our class, Practical and Tactical Actions for Plan Sponsors. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CFP, CIMA, CCWA, CIMC, RMA, CPE, and SHRM. For CPE, please make sure to answer the 3 polling questions that will pop up during the broadcast. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will appear when you log off. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we'll definitely follow up with you afterwards. And my last item, tomorrow, you will receive an email with a link to replay today's broadcast, and it will also include our contact information should you wish to reach out. Let's get started. Our instructor today is Mary Reed, Pentegra's National Director of Qualified Plan Marketing. Mary is a specialist in qualified tax advantage strategies for small business owners. She helps those business owners turn a good year into a great year by keeping more of what they've earned. Mary, thanks for being here today to lead the class. Let's talk practical and tactical actions.
Okay, thank you very much. And thanks for joining, everybody. Hello. So let's jump right into the topic. We'll talk about some things that businesses can do. We're just going to talk very briefly about PPP because that's pretty much behind us now. But we will spend some time talking about 199A. That's from the Tax Cuts and Jobs Act. And that seems to have gotten forgotten about a lot, but it's still definitely relative to businesses. And it's kind of had a resurgence from a new proposal that was put in. We'll talk about how to help business owners keep more of what they work so hard to earn, reducing liability when it comes to the company's retirement plan, looking at from the perspective not only of tax savings, how this helps the business owner, but also how it can help attract and keep key employees, and ultimately create a better workforce to make that company more successful. So our objectives will be, are defined right here: determine which retirement plan contributions count towards the loan forgiveness, understand the basics of the 199A rules, how to use retirement plans to achieve business goals, learn, we'll touch briefly on plan governance and kind of fiduciary issues there. Again, we're going to just touch briefly on some executive compensation as alternative to qualified plans, and also wellness programs and how this all goes together for an employer for their employees. So let's just talk for a brief second about PPP. PPP really, those were the pension protection loans that came out of COVID. That door obviously is closed. There was the opportunity for people to take 2 different loans and have those loans forgiven. So, this was all in 2020 and 2019. And so I'm not really going to focus on this. I do want to mention, however, there are some new things that are still carrying on for employers to get deductions related to payroll. And the numbers could be quite substantial for some employers where they can get a credit for keeping people on payroll. So that's not in the agenda to go into today, but I do want to refer you. There's an upcoming accounting show. It's normally held in Manhattan, but they are virtual this year. It's the Accounting and Finance Show of the USA. It's a very, very large show, several thousand attendees usually, but everything is online and virtual this year, and it is free to attend. That is running from December 7th to 8th. I just recently recorded a session with a panel for that meeting where some of the other panelists, much more expert than I am on these issues, talked about the payroll credits. They could be multiple thousands of dollars for businesses, and a lot of businesses are not really aware and really should be learning it and so they can take advantage of those credits. So I refer you to that show. Tomorrow in the follow-up, we'll include information and a link of how to get to information on that show. Again, it's December 7th and 8th. If you want to Google it, it's the Accounting and Finance Show USA. And there's some very helpful information there to help employers get credits that go, now that the PPA door is closed, to get some ongoing credits for payroll. All right, so let's dive into 199A because this is very much still with us. Recently, in the Build Back Better Act and all the other legislative activity and proposals, the bills that have been going on, there was a proposal to change 199A, and some of those who are listening in may be aware of that. That was rescinded. Doesn't mean it won't come back. But we still have 199A in the existing format that we were given in the Tax Cuts and Jobs Act. So that is still with us. So that's what we will talk about today. This does affect a lot of our small business clients. So basically what 199A says, when the Tax Cuts and Jobs Act came out, that was the act that reduced the corporate tax rate down to 21%. But for pass-through entities that are not at the corporate rate, they did not get a reduction in taxes. So they gave them 199A. And what 199A offers is a 20% deduction off of qualified business income. However, they went beyond that. Not everybody gets the 20%. They made some special rules for service entities that can limit the amount of the deduction. And so that's what I'm going to talk about today. There are phase outs for the deduction. Again, there have been some proposals here that would do some things better to this, some things worse, but right now they are off the table. So just in simple math here, if we had someone who had qualified business income, so let's say they're a sole proprietor and their net taxable income is $100,000. They've taken all their other deductions. Well, they would qualify, and assuming they qualified here for that 20% deduction, it would be 20%, so that's a nice $20,000 deduction. So this could be quite meaningful. It will be 20% of whatever the qualified business income is. Obviously, it might be substantially more than $100,000. So this could be some meaning dollars for businesses, and businesses want to get this deduction. And when the Tax Act first came out, there was we had a lot of activity and a lot of conversations from business owners who were above the threshold that we'll get to and wanted that deduction, and how could we get to it. So this affects anybody who's a pass-through entity, so pretty much anybody that is not a C Corp, sole proprietors, partnerships, real estate investors, S corporations, REITs, qualifying cooperatives. It's pretty much anybody who is not a C corporation is wrestling with this or has looked at it and would probably like to get the deduction if they can. So before we dig into more details of how it's defined, I'm going to turn it back to Beth. We're going to do the poll now. She will ask the question, and you can put your answers in.
All right, everyone should see the quick poll that's on your screen. What is the maximum QBID, if I'm saying that correctly, allowed? So please select one of those four answers. I'm going to give you a couple more seconds here so that we can make sure everybody's answering. Okay, let me close the poll, and then Mary will be able to continue on. So here we go. Let's close this. All right, Mary,
Okay.
back to your screen. Thank you.
Okay, thank you. All right, so let's dig into how this really affects people. So partnerships, we're looking at Schedule C. Now, this is for the qualified business income. Let me just back up a step. When we get to the thresholds of whether people get this deduction, that's total income, total household income. But for the deduction, what income that would apply to, we go to the qualified business income. So for a sole proprietor, that would be their Schedule C. Partnerships, it would be their K1. Farmers would be Schedule F, and S corporations would be the 1120S. That's the number when we get to the income on those forms that the deduction would apply to. So sole proprietors, partnerships, right? They don't have any W-2. It's purely what comes through on that K1 or that Schedule C. So that's pretty straightforward. The S corporation has W-2 income and pass-through income. This is on the pass-through, not the W-2. Now, in the qualified world, which is my world, we're always making a distinction because for S corporations, for any kind of plan contribution, we can only recognize W-2. We don't get to recognize the pass-through. So you do want to distinguish between those two streams of income when you're talking to someone. Now, this is the threshold. If you are in certain select businesses, and I'll bring that list up in just a minute, and your income is over the defined threshold, you will lose that 20% deduction. So these thresholds are adjusted every year for cost of living. Right now, if it's for a couple who's married filing jointly, it's $326,600. For someone filing as an individual, it's $163,300. Now remember, this is total income. So if I have someone, for example, who has a business, and let's say they're a Schedule C, so they're qualified, their net Schedule C, their qualified business income is $200,000. Well, they're below the threshold. So, okay, they're fine. They can get their 20% deduction. But suppose they're married to someone who earns another $200,000. Well, now their total income is $400,000, and they are above the threshold, and they just lost their 20% deduction. So it's total income, not just the income from that business, that's going to count in determining this. So now these limitations only apply to specified service trade or businesses. So if you are a manufacturer, for example, you are not a service company, you don't have to worry about these thresholds. But if you are a service company, you do. In the small business arena that we deal with every day, and then I'm sure you deal with every day, the majority of the businesses really are service businesses. Occasionally they're not, but the majority of them are service. So we're talking about businesses in the health industry, law, accounting, actuarial, any kind of consulting. Athletics, for example, professional athletes fall into this category. Financial and brokerage services and performing arts. Those are all considered specified service businesses. Now, they did put in some exclusions. They excluded specifically from the definition architectural, engineering, and retail. And they also excluded certain real estate professionals. So absent those particular exclusions, if you have a client who's providing service, they're probably under the specified trade or business. And so they have to watch out for that threshold for whether or not they will get their 20% deduction. So here you can see the thresholds on this graph. You see the phase out here. They're fine up to $326,600, and then it starts to phase out. If their total family income is over $426,600, they will lose the deduction. For the single person, it phases out between $163,000 and $213,300. So where does that leave us? So if I'm talking to someone and they own a business and their income is over the threshold and they've lost their 20% deduction, I don't just say, okay, that's too bad, and end of the conversation. There are things we can do to get that business owner's income below the threshold. We can bring deductions, right? If they can get more deductions off their income, if they can afford to do that, we can potentially get them below the threshold. They'll not only benefit from the deduction of whatever's been put in place, but they'll benefit from gaining the 20% deduction as well. So basically, you split into two tracks here. Here's our specified, businesses again, same list. You're either below the threshold and you get your deduction, you're over the threshold and you lose the deduction, or you're in the phase out period where you have to figure out how much of a deduction you get. Now, in the new proposal, by the way, they were taking away these classifications. Well, it didn't say that, but in fact, they were taking away the classifications and capping the 20% deduction for everybody. That would be a significant change for the people who currently don't have a cap on their income for the deduction, unlike the service trades, which already do. As I said, that was pulled from the bill. We will see whether it comes back or not. Okay, come on, slide. Change. Okay. So again, two categories. You're either below the threshold, you get your deduction, or you're fully above, you get your deduction, or you're somewhere in the middle, and you have to do the calculation of the phase out. Now, if for someone who is going to lose that deduction, depending on where they are, if your income is below the threshold and you're going to get that deduction, there is a form you have to file. It's Form 8995 with your tax return. If you are in the threshold, the phase out threshold, but you're not, I'm sorry, if you're more than the threshold amount, then it's Form 8995A. So just a little tax reporting information there. So how can I maximize that 199A deduction? Because that's what business owners would like to do. This is where qualified plans come into play. If we put in a qualified plan for a closely held business, we can give them a deduction. Now, how large a deduction depends on what type of plan we do and how many employees that they have. But for example, if to make this simple, let's say we're doing a one-person business, just a sole proprietor, and their income is over the threshold and they have the cash flow wherewithal to make a contribution to a plan to get them below the threshold. Let's say they were $200,000 above the threshold. We give them a plan contribution. They put in $200,000. They get that deduction. Now they're below the threshold. Who did they give the money to? They gave it to themselves. They still have the $200,000. We're just recategorizing what that money is called. So this is not an expense. They're not giving it away. They're just repositioning the money in a way it's deductible and will bring their income down. So there are lots of different design options. It's different for every company. Every company is a custom design because every company looks different. Every company has different cash flow. The owners are different ages. They have different numbers and different ages of employees and different compensation. So every company is different. And a lot of business owners really are unaware of all the options that are open to them. The ones that people tend to know about, might be IRAs, SEPs, simple plans. Maybe those are all kinds of IRAs. Then we have 401k plans, which could be for a one-person business, a solo K or an individual K. Or it might be a bigger 401k with employees, but there are a whole world of other plans that are available. And which one is right and which one will get the job done is a question of their demographics, their budget, how much they can commit to, and where we can get them to within those parameters. So for companies that don't have a plan, it starts as a fairly simple conversation. Would you like a tax deduction? Yes. How much of a tax deduction are you looking for? How much can you afford from your cash flow to put into a plan? Those things will determine what kind of plan we're going to get to, but sometimes it's not always just about tax savings. Sometimes it's about saving for retirement. Business owners tend to have a common plan for retirement. And that plan for retirement is they're going to sell their business when it's time to retire. That's the answer that you'll hear most from business owners. And that sounds nice, but it's not a very reliable plan. How do you take this business that this business owner has built up into a successful enterprise and convert that into a stream of retirement income? It's not an easy thing to do. When it comes time that they're going to sell because they want to walk away and retire, what if they can't find a buyer? What if the market is not good? What if they have a buyer, but the buyer can't get lending to buy it? There are a lot of things that could happen. And for that business owner who hasn't made any other plans, they may find themselves kind of stuck that, well, either I'll keep working, for as long as it takes until I can sell the business, hope they don't die in the meantime, or sell the business for whatever they can get and adjust their lifestyle accordingly. It's not a wonderful option, but it's one that most business owners are pursuing. Also, a lot of business owners tend to overvalue their business. They tend to think it's worth more than the world thinks it's worth, and won't be able to sell it for what they think. The other thing, a lot of businesses that are successful is because of the business owner. And if you take that business owner out of the picture, you don't really have much of a business left. So those are all factors. If we put in a qualified plan for that business owner, not only can they benefit from current tax deductions, but will help them accumulate money that they can use for the retirement. And it could be a substantial amount of money. In a defined benefit plan right now, we can accumulate about $2.9 million for somebody. So it may not be all they need, maybe some of what they need, whatever, it's a big step in the right direction. Another reason that employers will put in plan is because they have competition in the marketplace, and they need to attract certain kinds of employees or certain quality employees and hold on to them. So that's another reason that employers will put in plans. But almost always at the first part of the conversation, it's all about tax deduction. People are driven to do qualified plans because they hate paying all the taxes. That's usually the beginning of the conversation. Now, if they already have a plan in place, good for them. They understand the advantages of having tax deductible contributions. But then the question for them is, has your plan been maximized? Are you getting what you want out of this plan? Is it operating in a way you like? Are you giving your employees the amount you want to, or would you like to change that if you could? Is it attracting the employees you want? All those things are conversations to have. Offer a free review. We can review the plan and give them our opinion as to whether we think it could be better or not. Also, these days on the 401ks, a lot of conversations about fiduciary liability. Employers who adopt these plans, big or small, usually do not realize that they are a fiduciary in the plan. If they're the employer, they're fiduciary. If they're a trustee, they're fiduciary. If they're the official plan administrator, which they will be, they are a fiduciary. As a fiduciary for the plan, they are personally liable for anything that goes wrong. So they are very exposed to liability. There's no corporate veil here. It could go right through to their personal assets, their personal home, or whatever. That's a pretty scary conversation to have with a business owner, but it is true. All right, so here's kind of a quick snapshot of the plans and who can have them. There are many more plans than this. We do a lot of defined benefit plans for closely held businesses because we can do very large contributions in those plans. So over here in this column, there's really 4 different kinds of defined benefit plans, including cash balance, which we will talk a little bit about today. So this chart really is much more expansive than we're seeing. This is just kind of a simplified version. But basically, who can establish? Any business can have a plan. The only exclusions that plans they can have is government entities cannot have 401ks. They get to have 403bs. Absent them, absent a government entity, pretty much any business from a one-person business to multiple lives can have any of these types of plans. A simple does have a limitation. A simple is an IRA, and the SEP and the simple are both IRA type plans. They are much more limited. They are much more restricted. If you have more than 100 employees, you cannot have a simple. You probably shouldn't have one anyway, but there is a 100 life limitation on the simple. In simple IRA, a simple IRA was created to mimic a 401k plan in that both have salary deferrals by the employees. Pre-tax salary deferrals in a 401k. We can also have after-tax Roth salary deferrals. There is a required employer contribution in the simple. The 401k, that would be controlled by the design of the plan, whether we have an employer contribution and what that looks like. Also, the maximums will be different. In a SEP, that's all employer contribution. The maximum that can be contributed is 25% of pay. Everybody gets the same percentage in a SEP. So 25%, if someone makes $100,000, the most they could get is a $25,000 contribution. Now, that is the same contribution limit that we have in a profit sharing plan for the employer contributions. However, there is a big difference. In the SEP, everybody will get the same percentage. In a profit sharing plan, we can spread that lump of money, that 25%, around in a variety of ways, not giving everybody the same percentage. That's part of plan design. We don't have that design flexibility in a SEP. The other plans, so those are employer contributions. SEP, profit sharing, that's all employer contributions. Same thing with defined benefit plan, it's all employer contribution. Now, defined benefit plans don't have a limit on the contribution other than what is actuarially required to fund the benefit. Now, there is a limit on the benefit. Right now, if we convert that to a lump sum, it's about $2.9 million. It is defined as a life annuity, but you convert it to a lump sum, we know what that is. And I'll give you, by the way, I have the new numbers are out. You see here the maximum potential for participants, 57,000 in 2020, 58,000 in 2021. That's the limit for this year. The maximum salary deferral in a 401k is 19,500. It's 16,500 in a simple plan. And then we have catch up on top of that. It's 6,500 in catch up on the 401k. So in a 401k, if someone were eligible for the catch up, the total they could receive between all the contribution types would be $64,500. Right? Without the salary deferral, with the straight profit sharing or a SEP, it would be $58,000. Now we have the new limits in for 22. That $58,000 has gone up to $61,000. So next year we'll be able to put a few more $1,000s in. The $19,500 salary deferral limit in a 401k has gone up to $20,500. The simple deferral limit has gone from $13,500 to $14,000, and then a $3,000 catch-up. So these numbers do creep up. On a defined benefit plan, that $2.9 million is really a reflection of conversion from a life annuity. The benefit is limited under a life annuity definition, so this would be an amount payable per year for life. Currently, that amount is $230,000 per year, and that number is going up to $245,000. So come 22, we'll be able to put a little more money into all of these plans because pretty much all of the limits have climbed a little bit. So here's a chart. This looks like way too much information on this chart. But basically, what this chart is trying to get at is, so if I'm talking to a business owner and I have all these plan types to choose from, how do I know which one to do? So the real way to know which one to do is to get a fact find, very short fact find, information about the employer, and then census for all the employees, and get proposals run. We do that here at Pentegra. And we'll come back and show you what they could actually contribute in the different types of plans. But really the solution, even before that, is we're going to always ask, what's their budget? Because if you tell us their budget is $50,000, we're going to design something very different than if you tell us that it's $250,000. So if we look to the column on the left here, basically for someone who's looking to do, no more than $7,000, just do an IRA. You don't need to go to a qualified plan. You can do that in an IRA. If they wanted to do more and maybe they just want to do the salary deferral in a simple, they could do that and pick up the additional 2% employer contribution. And if they're happy with that limit, that'll bring them to about $22,300 for someone who's over 50. Then just do a simple. That's nice and easy. There's no expense to maintaining it. If they wanted to do a little more, and maybe there's employees, so they want some more control, we go to a 401k, just salary deferral only. That will now get them up to $26,000 instead of $22,300 if we go to a 401k. The simple, if we add a match instead of the fail-safe, there's two different options there. Maybe we'll get somebody up to $33,000. So you see it's climbing. Depending on their income, a SEP might give them a greater or a lesser contribution. It depends how much their income is, because your salary deferral can be up to 100% of pay, but we know the SEP contribution is limited to 25% of pay. So, for example, if they had $100,000 of pay, the SEP would only be a $25,000 contribution, and maybe they could do more just with the simple. But if their compensation is $200,000, it will be more in the SEP. So if they want to go beyond those limits, now we really step into the world of the true qualified plans, 401k, profit sharing, and defined benefit, where we can drive these numbers higher, and in some cases significantly higher than we could in any variation of the SEP or the simple. So it becomes a combination of how much do they want to contribute, what is their budget, how many employees are going to be in the plan. That's going to affect it too. And beyond that, if there are employees in the plan, who do they want to get what? Are the particular employees, including themselves, that they want to favor over other employees? And lastly, the expense of operating the plan. There are expenses involved in operating these plans. SEPs and simples tend to be very popular because you don't need a third-party administrator. You just fill out an IRS form, and the money goes into IRA accounts, and there are no more expenses. When you go to a 401k plan, a profit-sharing plan, or a defined benefit plan, it is more complex. You need a third-party administrator. There are things that have to be filed with the IRS. There is compliance work that has to be done, and so there are fees to operating and administering those plans. However, everything has to be looked at in perspective. If they're getting the contribution they want, and maybe a much larger contribution and giving less to their employees because we've gone to a profit sharing or 401k or a defined benefit plan, depending on their objectives, and what they're gaining far surpasses what they have to pay now for that third-party administrator expense, then it's definitely worth it. It's not just, well, we're adding an expense to you. You're gaining. You only do that because you're gaining something that's going to benefit that business owner. So with that, I'll take a little breather here, and we'll go to our poll question number 2.
Very good. So it is now up on your screen. Which type of plan allows for the most contribution flexibility? Please select one of those, and we'll give it a couple of seconds here while people are answering the question, sorry. And just remember, we need you to answer the poll question if you're requesting CPE credit. Give it about 15 more seconds. All right, I'm going to close the poll. All right, Mary, you can continue on.
Okay, thank you. And I was just, going to say they don't get to vote again. November 2nd is come and gone. They only get to poll.
Okay.
Okay, so let's talk. I'm going to spend a few minutes now. We're not going to go, in detail into all the plan types, but I do want to talk about cash balance plans. They've become very, very popular in the last couple of years. They've been around for much longer than that, but for some reason they've jumped in popularity. In the last couple of years, we're doing quite a few cash balance plans. And there are some reasons for that. So I want to kind of give you a glimpse into that. So what is a cash balance plan? A cash balance plan is often referred to as a hybrid plan. It is, in fact, a defined benefit plan by definition. So that means our contribution is not limited to $58,000. So we can go to those much higher numbers like we could in any other defined benefit plan. The reason it's called a hybrid plan is because of the way the benefit is defined. In a traditional defined benefit plan, you'll see a benefit formula, something like, you receive a benefit of, let's say, 100% of pay when you reach retirement age. Retirement age will be 65 or 62 or somewhere in between. We can't use the ages other than that. Or it might read something like you'll get a benefit equal to 1.5% of pay for every year of service that you've been here. So it's a future benefit payable at retirement age. If an employee were to leave before retirement age, to know how much their benefit is worth when they leave, an actuary has to calculate it back into present value. So let's say they were going to get a benefit of $20,000 a year when they hit age 65, but they leave when they're 50. How much is that worth? Well, that $100,000 a year at age 65, let's say, was worth $1 million. They leave at 55, maybe they're going to walk away. The actuary calculates it to present value. Maybe it's worth $400,000. So there's this back and forth on the calculation. In a cash balance plan, the benefit is defined as an annual current contribution credit. So everybody always knows what the current value of that benefit is. So let's say someone was getting a contribution credit of $100,000 a year. They know if they were to stay for 10 years, they would get that 10 times. Their benefit in 10 years would be 10 times $100,000. Plus, they would get an interest credit each year that would be added to that. And that interest credit is either an amount defined by the plan document or it may say market rate. So anybody at any given time knows what their benefit is. And it's tracked in an account. So it looks like, to participants, it kind of looks like a 401k plan. They see an account, they get this contribution credit, they get an interest credit, and that's their benefit. However, behind the scenes, there are no individual accounts. It's one pooled account. The employer is the one who's responsible for making the contributions to fund those benefits. And the interest credit and the market risk on those benefits rests with the employer, not the employee, right? If I'm in a 401k plan and I put $10,000 into my account, and I do that every year, well, when I retire, how much will I have for retirement? I have no idea. It all depends how much money I've put in and what the investment performance on that money has been. If I make money, I get to keep it. If I lose money, I get the loss. A cash balance is very different. Your benefit and that interest credit is defined by the plan document. It's got nothing to do with the assets that are supporting that behind the plan. Any risk on the increase or loss of those assets is borne by the employer, who has to make a contribution and compensate accordingly to make sure your benefit is funded. So the way these work, a plan is designed, right? You have standard eligibility, just like you would for any plan. You know, how long do they have to work before they get in the plan? Usually it's 1 year of service, have to work 1,000 hours during the year. They'll enter the plan. You can have a vesting schedule in the plan. This is different from all other plans. Cash balance plans must have a 3-year cliff vesting. Other plans can have a 6-year graded vesting. You cannot do that here. Compensation for calculating the benefit is the same as any other plan. If it's a pass-through entity, it's going to be earned income. If it's a sub-S or any other kind of corporation, it'll be their W-2. You do need a TPA and an actuary here to do all the reporting and the testing and the calculations. The actuary will calculate every year what the contribution needs to be to keep the plan funded. They will tell that, they'll actually give a range of contribution to the employer. The employer must make that contribution. This is not flexible like a profit sharing. They are committed to making that contribution. As I said, the assets are invested in one single pooled account. There are not actually individual accounts, even though the benefits look like individual accounts. So how do we create this? You will see, if you see a cash balance design, they're almost always paired with a 401k. So what does that mean? That means we have 2 separate plans. We have a cash balance plan. Remember, that's a type of defined benefit plan. And we have a 401k plan. They're separate plans at the same employer, but we test them as if they're one. We test them together. And the reason we do that is because when we come to testing, we get better leveraging on the amounts that go into the profit sharing plan than we do in the cash balance. So why would we care about that? We care about that because that gives us control over how much we have to contribute for individual employees. So the reason employers go to cash balance plans, it's all about control. It's all about control. It's all about controlling who gets what. And we have to give a certain minimum to employees to pass testing. If we were to do the cash balance alone, those minimums we would have to give the employees typically would be higher than the minimums we have to give them if we combine it with a 401k. And for most employers, their objective is to benefit themselves as much as possible and their employees as little as possible. The cash balance creates the tools to do that more than a traditional design would. Okay, all right. So how will the funds be invested? So that's how we do the design. And when we run a design, we start with the business owner and whoever they want to favor, and we kind of back into what do we have to give everybody else to get there, and that's how we create a plan design. Now, if there are employees they want to favor, we will always do that, and we certainly can do that. It's much easier to favor people than to not favor them. So that's our plan design. Now we tell now we go to the employer and say, here's the contribution you have to make to fund this plan. As we said, it will be one pooled account. We're funding not only the benefits each year, but an interest credit that will be given to the employees on those benefits. 5% is a common rate to use. And this is a choice when the plan is designed. It could be a fixed amount, 4%, 5%, whatever, or it may change and be tied to market rates. That is a design decision when the plan is designed. Now, one of the risks here on the investments, we have one pooled account funding the plan, and let's say we're giving an interest credit of 5%. So we know we're going to give 5% to the employees, so it'd be nice if we earn 5% on the money. That will keep us pretty level. But we have some investment advisor who does a really great job, and instead of earning 5% on the money in the plan, they earn 15%. Well, now our contribution next year will be less. Because remember, if we had extra earnings, they don't go to the participants in the plan. It's just part of the funding. So now we have to put less money in to end up at the same place because we have a surplus of funds in the plan from the extra earnings. Let's say the investment advisor didn't do such a hot job and they lost 15%. Then next year's contribution is going to be higher because we have to make up for that loss. For the employee, they're still getting their 5% credit either way, and their contribution credit, whatever that's been defined, either way. Their benefit doesn't change. It's the funding that the employer has to put in that changes. So who are good candidates for cash balance plans? If there are employers who want control, sometimes we do these for owner-only businesses. It's only one person, so what do we care about controlling the money? We can flex the contribution if that business owner has the ability to change their compensation. So let's say they're a sub-S and they want a really high contribution this year. So on their W-2, they take $200,000. Next year is not as flush, and they want to cut back their contribution, not shut down the plan, but cut it back. So maybe they change their W-2 to $100,000. That would cut their contribution essentially in half. So they gain that control. When we get into groups that have employees, groups that naturally tier their employees, it's a real nice, easy match. Things like medical groups, law firms, right, where you have senior attorneys, junior attorneys, paralegals, those kind of things. Those are really good matches because we can tier the benefits to match up with the tiers of the employees. CPAs, financial service consultants, pretty much any company that's looking for a larger deduction and likes the flexibility in steering the money that a cash balance can give. Excellent candidates are companies, any company who wants to do a qualified plan is because they're profitable and they have cash flow and they want deductions. But good, excellent candidates for cash balance plans are also companies that already have a 401k in place, but they have more money to work with. You know, think of a doctor's office. They've got a 401k in place, and maybe it's a very nice 401k, and that doctor's getting $58,000, but they would really be happy if they could get $200,000. They just don't know it. We could get them there by adding the cash balance potentially. All right, so now let's that's kind of cash balance world. And if you want to know more about those, we certainly help you here at Pentegra. So let's kind of flip the switch here and just talk about liability for a minute. Whenever you have a qualified plan, there are lots of things that have to be done. We call this plan governance. I was afraid there wasn't one. There we go. All right, so somebody has responsibility for doing all these things. Selecting and monitoring the plan service providers is one, overseeing the plan investments, operating the plan in accordance with all the requirements. Documents, this is a legal plan. It has a legal document that creates them. Those documents have to be kept up to date. There's reporting that has to be done, both to the government and to the employees. That all has to be done. We have to not have conflicts of interest. You can't have self-dealing. You can't have a business owner taking the money in the qualified plan and buying their personal house, for example. That would be self-dealing. And so you need governance to monitor all of these things. And the details will be different depending on the type of plans. For example, if you have a 401k, you need employee education. You don't need that as much on a defined benefit plan. All these things carry responsibility. There are fiduciary liabilities involved with all of these. These are fiduciary responsibilities. And so today, in the more recent market, I would say in the last 5 to 10 years, but particularly in the last 5 years, more and more the market is moving towards offloading some of these responsibilities onto service providers. They can offload, for example, the administrative fiduciary responsibility. They can offload the investment fiduciary responsibility. There are different degrees and different levels an employer could choose to offload. They have to pay for that service. It doesn't come free, but it can help a plan stay more secure, safer, to make sure it's operating more safely, protect the owners from their fiduciary liability, although they can never offset 100%. But this is very much a topic, particularly in the 401k market these days, and these services have become more of a commodity over recent years, so there's more price competition, whereas they used to only be for the very larger plans because the expense involved. Now these services have become available down into the small plan market and should be considered by a lot of employers. All right, and with that, I think we have one more poll question to do. Why don't we do it now?
You are correct, Mary. One last polling question here. How can plan sponsors ensure they have effective plan governance process in place? So again, let's give it a couple of seconds here, and remember, if you're requesting CPE credit, you need to answer this question. And give it about 20 more seconds. All right, the last 5 or 6 seconds here. All right, I'm going to go ahead and close it. All right, Mary, back to you.
All right, thank you. Thank you. All right, so we're in the home stretch here. So let's just take a very quick look about what about non-qualified. Qualified plans are not for everyone. They do a lot of really good things. Tax deduction, also the money that goes into a qualified plan, if there's at least one rank and file employee in there, is fully protected from creditors. So it's a very safe place to put money where no one can get at it except the IRS and your spouse. It's a way to grow money for retirement. It's a way to attract and retain key employees, but it's not for everyone. And sometimes people want to do something outside the qualified plan to benefit employees. And there are lots of programs to do that. However, there may or may not be tax advantages depending on the type of entity that the employer is, right? So if they're a past or business entity, there's no separation between the corporation and the owner. It's not like a C Corp where you have that corporate line. Everything passes through onto the owner's tax return. And so you don't have separate tax rates. It's all at one tax rate. It all passes through gains, losses, contributions, whatever. And so to do something, non-qualified plans are usually done when you want to benefit one specific employee or a select group of employees, but not everybody. And there is a lot of value to that. But typically in a pass-through entity, there will be no deduction for doing that. So these plans come in a variety of forms, pay as you go. And you can see that here on the screen. Sinking fund, where money is actually put into some vehicle and held there to accumulate to pay those future benefits to somebody. And then in the institutional world, we have COLI, BOLI. That's a very specialized world. So while these programs can be very valuable for holding on to employees, we don't see them in pass-through entities typically because there is not a tax advantage. If the company is a C Corp, and we do have some small companies that are C Corps, then that becomes a different story because now there are deductions involved and way to separate and have different tax rates on the money. And we see them there. Plus, those tend to be a little bit large organizations where there are key employees that are being selected out. So it all depends on the situation of the entity and what they're trying to accomplish. Keep in mind that in the qualified arena, we do have the ability to benefit select employees within the rules that we have to work in, but there is that opportunity there as well. So here's just a little example. If we did do one of these non-qualified, here's a company that's got $10 million in revenues, $9 million in business expenses. That's a lot of expenses. For a key employee, the owner makes a $250,000 after tax contribution and they do it into a rabbi trust, right? This is a non-qualified plan. The contribution is reported as taxable pass-through earnings for the owner. And the rabbi trust earns $10,000, which is an additional taxable income for the owner. So you see, we may be getting a benefit for the employee they want to benefit, but there's not a tax benefit for the business owner here. So how do I create a better and more productive workforce? Well, it's different for every company, right? They have to look at an array of things. None of this happens in a vacuum. What are their health benefits? What other benefits do they offer? Do they have the cash flow and want to do a qualified plan? Do they want a 401k component so employees can save? Do they want to select out certain employees to give some specialized benefits to? All the things that are on here on the screen here, none of this operates in a vacuum. So it all has to be considered, and it all frequently will be part of the conversation. Doesn't mean you need to be the expert in all of these things, but most of these things, or many of these things, will be on the employer's plate to figure out. And of course, when we're dealing with closely held businesses, there is almost never a human resource person. These are decisions that the business owner is making in how they want to operate their business and how they want to treat their employees. So with that, we have a few minutes left. If there are any questions, we can answer them. Beth, either you can read them if there are any, or I have to shut down my screen because otherwise I don't think I can see them. Can I see them?
Okay.
Maybe.
Yeah. You may.
I just opened the panel.
All right. Right now we don't have any questions, but if somebody thinks of something and interrupt right quick, I do want to remind the attendees to please complete the survey questions that are going to appear on your screen when you log off. That will help us to evaluate how we're doing. And again, you'll receive the email tomorrow with our contact information. So if you think of a question after you hang up, tomorrow we'll be glad to answer any questions you might have. Thank you everyone for attending. Oh, I see a question coming in, Mary. What's the last day to submit for a qualified plan this year with Pentegra?
Oh, that's a great question. The Secure Act changed the deadline for the first time that I know of. It used to be that a company had to adopt a qualified plan by the last day of their fiscal year. So for most people, that was December 31. The one exception to that being a SEP, which the employer could do up until they file their tax return. Now the employer can adopt any kind of plan up until they file their tax return. The only exception there would be a 401k, because we need time for the employees to be able to defer. So if they want to do a plan for 2021, we're past the deadline for a 401k. But any other kind of qualified plan, they could still do up until they file their tax return for the year, even with extensions. We do run out of time on defined benefit plans on September 15th. So because 8.5 months after the end of the year, they have to fund. But that's a long time out after the close of the plan year. So the nice thing of that for employers is now they can wait and see how their year turns out and see how profitable they are before they have to make that decision of whether or not to adopt the plan and what kind of plan will serve them best. So we have a lot of leeway. It doesn't mean they should procrastinate. I still think they shouldn't procrastinate, but we don't have that December 31 hard deadline hanging over our heads anymore.
Great, good. That was a good question. Thank you. All right, I don't see any other questions coming in, so I'll give everyone back 6 minutes in their day. Thank you for joining us, Mary. Thank you for instructing us, and have a good rest of the day, everyone.